I'm Ian Taylor, president of the CFA Society Ottawa this year, and I want to welcome you again to another webinar event in our series that we started last summer. I think we're up to almost 25 events now, and they continue to be very well attended. So note that most of our events are available for replay. So if you miss anything during today's discussion, I believe we will have this one posted to the website as well. And you can certainly go look back on some of the great topics and speakers we've had over this time. Before we get into today's speaker, I did want to give a quick update on some of the happenings at the CFA Society Ottawa. So obviously the progress of the pandemic is, there has certainly been progress and we continue to monitor that. But for the near term, we're certainly going to continue to do most of our interactions with you virtually. And we had to make some decisions around some of the key programming that we typically run. So we are going to remain virtual once more a year for the forecast dinner. So that's something that we've decided on over the last couple of months. But I am excited. We do have a good lineup. We have secured Stephen Polas, who obviously was the former governor of the Bank of Canada. So that's really obviously going to be very good, and we're going to be focusing a lot on the future of central banking. And we also have Catherine Murray from the Business Network, who's going to be moderating the event. So I think it's going to be a really good evening. And we'll also have Becta, once again, providing the wine experience, so wine tasting throughout the evening from the comfort of your own home. So look for that. We haven't started registration yet, but we will get that posted for April 14th. So it's still a number of months ahead. But back to the topic today, and really today's topic is, well, I think it's been a dominant theme for a number of decades now, but it is, I think it's a very very important one here over the next year for sure, and certainly right now what we're seeing in markets. So when we start to focus on China, we certainly know back in the 2000s really came to prominence on a global stage and started to really influence capital markets significantly. A bit of a transition over the last decade, somewhat more inward looking potentially, and now this next decade, and I think that's where the focus will be. And it is some of the changes that have happened over the last year and some of the shift that we've seen cause us to wonder whether this is actually perhaps it is the end of capitalism in China. And I believe today's speaker is going to tell us otherwise. So I'm really happy to have Nick Robinson, Senior Investment Director of the Global Emerging Markets Equity Team at Aberdeen, with us today. He joined Aberdeen back in 2000 and spent 8 years on the North American Equities team before moving to the Global Emerging Markets Equity team, spending some time in Brazil to set up offices there. He's now back and based in London. Nick graduated with an MSc in chemistry from Lincoln College, Oxford, and is a CFA chartered.
He's having a little bit trouble with his internet, but Nick, would you like to begin your presentation?
Sure, yeah, happy to. Thanks for that introduction, Ian. Hopefully everyone else can hear me. I'm never really sure if it's my dodgy.
Please welcome.
Sorry, not sure if it's my dodgy British internet or something else going on. But yeah, thanks very much to everyone who's joining this today. Thanks very much to the CFA Society of Ottawa for very kindly inviting me to come and talk to you. So in terms of the format for the presentation, I mean, first I'll talk a little bit about what has happened in China, and particularly focus a little bit on the economic backdrop to which this regulatory uncertainty has occurred and how it's been impacting market. Then I'll talk about the regulatory changes themselves, what's been occurring and what the Chinese government is trying to achieve, and also why we don't think that it's a huge leap away from the version of capitalism that China has been following pretty successfully now for a number of years. So perhaps we could skip forward a couple of slides, please, to kick off the first slide. So this one is, yeah, that's great. So yeah, this first slide really just frames one of the issues that China is dealing with at the moment in the economy. So, and that's really, namely the debt load that the country has. So along with the rest of the world, China loosened monetary policy as we went into COVID. And so you saw a very big uptick in non-financial sector debts as a percentage of GDP. So at year end 20, that was about 290%. So pretty big increase on the year, but very striking increase from the end of 2008 when that same figure was 140%. There's also been a fairly steady and consistent effort to limit the growth of money supply. And again, during COVID, like most nations, there was a pretty big increase in liquidity around as more money was made available to businesses and individuals to kind of bridge the gap during lockdowns. But now China's been tightening again, so a pretty big effort to reduce the rate of growth of monetary supply. So we're seeing financial conditions tightening at least relative to where they were during the crisis. And I suppose one of the big areas and sectors that we're seeing that have impact is in the property sector. Obviously, the Evergrande crisis has loomed pretty large in investors' minds in recent months. And that's really a factor that's really come out of this 3 red lines policy that was introduced by the government last year. And that was really to try and make the property market more stable and slower growth within the economy. Property itself is about 30% of contribution to Chinese GDP if you include the supply chains. But I think it's a very large part of GDP, but also quite a volatile one, which it's been quite hard for the Chinese government to manage in terms of appropriately stimulating that as and when required. And President Xi has always been very keen and consistent in terms of his keenness that property is for living in and isn't a speculative asset to try and reduce the volatility. And so that 3 red line policy that was introduced to reduce leverage within developers, I mean, that's had the clear impact of increasing the cost of capital for those developers that have been more levered, and the fallout from that is what we're seeing in Evergrande. But what's been really interesting, I think, in this part of this crisis has just been the government's reluctance to re-stimulate the property sector. And really, I think that just shows the commitment they have to cooling this sector and making housing essentially more affordable. And that it's also quite striking that the government is talking about a property tax as well, and introducing a property tax essentially at this point. So it's really serious about changing the structure of the property market. So, and this is as you would imagine, it's potentially quite a big headwind to growth. So China's been growing at well above 6% for several years now. So we think it's quite likely that GDP growth in China is going to fall below that 6% level, maybe 5% next year, with a 1% or 2% impact from the negative property market. So Kathy, next slide, please. So obviously the impact of the property market is something that's likely to reduce confidence and potentially pressure retail sales. And certainly you've seen, after the collapse in retail sales we saw during COVID, you've seen a very sharp rebound as per most of the world, but now that's kind of declining again. So retail sales growth is pretty shallow at the moment. The other issue which is weighing on economic growth within China is this approach to COVID they have that's very differentiated now from most of the world, this zero tolerance to COVID approach, which is having in terms of a human impact, it's striking that the official, which may not be accurate, but the official numbers of COVID deaths within China are about 6,000 versus the population of 1.4 billion. So they've done a good job there, but it is having a reasonable economic impact. What we're seeing is reasonably regular, small regional outbreaks of COVID, and that's having some impact to GDP in terms of how those regions are impacted in lockdowns and the like. And with the approach they have, that's not really likely to change. So that's going to be a headwind to growth. And the other angle of that is, how is China's policy compatible with the rest of the world in terms of travel? How that's going to, if China continues to pursue this policy, it's really going to hit travel and tourism pretty hard. Obviously, there is some increasing domestic tourism within China, which is going to offset, but travel and tourism, again, is about 10% or so of GDP. So likely to be a continued headwind to GDP. And I suppose there's also the kind of less tangible impact as well that we're likely to see in terms of travel. And travel is important from economic growth in terms of getting FDI there, and how that occurs in a time of limited travel ability may add some headwinds to future growth. So if we have the next slide, please. So, talking about those kind of fairly big headwinds to growth, and now we have this other issue, which is, creating a certain amount of uncertainty within the Chinese government. And I suppose common prosperity and the idea of common prosperity is something that isn't new per se. The philosophy itself of common prosperity has been around since, or first mentioned at least in the 80s by the leader Deng Xiaoping. And really the thought back then was, the need, whether or not you introduce common prosperity kind of now or back then and try and level things up, or whether or not you try and create wealth first by allowing some people or regions to get wealthy first and then spread that wealth around. And so the latter approach was followed, where some regions got more wealthy, and now the goal is really to spread that around. So essentially to make the cake bigger and divide it more fairly, because the issue at the moment in China is the rich essentially are getting rich, and that wealth gap is increasing. So common prosperity, when we kind of look back at what's been going on in the last year, that really started in the back end of 2020 with the government looking quite closely at anti-competitive behavior within the tech sector. And at the time, it was a little bit hard, I think, for investors to really get a sense of what the government were trying to achieve. But as we went through in 2021, it became a bit clearer. Moves in the education sector, I think, caught a lot of investors by surprise, to be fair, including us, essentially banning after-school tuition and, or at least banning the ability to generate profits from that. And education wouldn't be one of the more obvious sectors you think would be on the wrong side of common prosperity. But in fact, the government took the view that, well, education was becoming an increasing financial burden, particularly the after-school tuition, and it's limiting population growth, as in the affordability of that was preventing parents from having more kids at a time when the one-child policy was being relaxed. I think there's another interesting angle to what happened in the education sector, which was essentially the main companies in that sector all have US listings. And so, the question, you could ask the question, would the measures been draconian if it was local shareholders that were losing out? And that's, perhaps leave that one hanging for a bit. But certainly it's been, since the common prosperity has been talked about more by the government in the last few months, it's been a little bit easier to identify where those areas of risk are within the market and areas which are perhaps less risky. And also I think we'd make the point that common prosperity is perhaps not a huge break with campaigns we've seen from the past in terms of trying to develop the economy and promote fairness. So we had the kind of anti-corruption campaign back in 2013, which was the largest anti-corruption campaign in Communist Party history. So 100,000 people were indicted in that campaign, a lot of very senior people. And certainly the impact of that kind of echoes today in terms of some of the way the government's gone after some of the kind of big oligarch type owners of companies in China. We've also had the Belt and Road Initiative, a huge multi-trillion-dollar infrastructure plan spanning 70 countries to promote trade along old Silk Road trade routes, hugely ambitious. The kind of made in China efforts, which are ongoing today, and I think we'll touch on a bit later in terms of how they're going to upgrade their manufacturing to more high tech and semis. And then kind of echoing some of the efforts that the government have been made to delever the huge shadow banking sector efforts in 2016 to try and reduce leverage within a shady part of the lending market. And then also the climate change targets, which have come out relatively recently. The net neutrality goal in 2060, which incidentally President Xi is likely to, or will be 107 years old then if he's still alive. So unlikely to see those ones out. So if we could move on to the next slide, please. Thank you. So how's this all impacted markets? Well, when we think about when common prosperity started to really become more of a factor within the investing landscape, that really started in the fourth quarter of 2020 when we saw the regulatory change in tech and Alibaba's having their IPO cancelled. You can see that up until September 2020, actually things were pretty good in terms of the China market. The China A-share market, so kind of onshore, domestically listed companies, not very much e-commerce there. It tends to be slightly smaller companies. They were performing pretty well, up about 10% in that period. The MSCI China index, which as it says here is dominated by e-commerce, so all the big tech behemoths are in that. Performing very strongly, up 16%. But then things change a bit from September 2020. So, suddenly the regulatory change is front of mind. It starts off with the e-commerce, and you see that sector being hit pretty hard from that. Meanwhile, the A shares are doing okay. A lot of that being driven by the fact that A shares are, as you probably know, being increasingly included in global indices. So the capital flow pictures have been quite good for those. So if we could flip forward, I think 2 slides now. So what's happening at the moment? So let's talk about what the government is trying to achieve. Well, essentially, it's as it says here, it's balancing growth, reducing inequality. But really, stability is key. Stability is key for the Communist Party in terms of executing their long-term growth targets and keeping themselves in power. Essentially, the majority of people need to feel like life is getting better under the party. That brings stability. Stability is good for companies. It's good for investors. It's good for companies when they're investing and trying to make long-term capital allocation decisions to try and benefit those companies. And the private sector has been hugely important for economic development in China. About 80% of job creation comes out to the private sector these days. The vast majority of tax revenues are generated from the private sector. So we think, why is this not the end of capitalism? Well, the government is unlikely to disrupt this significantly, given their stated goal of getting to a moderately prosperous society by 2035, and then after that becoming a developed economy by 2049 on the 100th anniversary of the founding of New China. And so relative, what does that mean in GDP terms? Well, relative to today, that's a threefold increase in GDP per capita by 2035. So they're certainly going to need the private sector and innovation in order to achieve those targets. But the model of growth that they've been following has increased wealth inequality. So the chart on this slide is really the the Gini coefficient and how that compares between China and the US. And you can see that essentially the Gini coefficient measures inequality, probably familiar with it. See that China is very much caught up. The rural-urban divide is part of the problem. You'd be familiar with the huge urbanization of China. That's likely to continue, albeit at a slower pace. So a lot of what is being done is really being spreading the money around in regions, and then also spreading the money or the wealth to within class groups. And a good example of this, say, would be a company called Meituan, which is a company that has a food delivery business amongst other businesses. And there, in China, the same debate that is occurring all around the world is happening in terms of how you treat those delivery drivers. What benefits do you pay them? What kind of health insurance do you give them? And China is settling on the point that these drivers will be employed in a more gainful manner than they have been in the past, and not allowed to be freelance. So that's pretty important. That's a good example of how there is another kind of the middle class is being broadened out, and of course these riders will be a bit more wealthy and will be able to consume and join that consumption class. And we think that's a very important part of the next leg of the China growth story. As that consumption class builds out, there's going to be a lot of companies that will benefit from money being spent by those individuals. But what are the risks to stability? Well, there's a few things that probably need to be monitored. I mean, firstly, debt and the funding, or debt and a potential funding crisis is a risk that's out there. Hence, the commitment to deleveraging, which is being done very much in earnest. China will be well aware of some of the risks to stability that have occurred in more developed markets in terms of the way information is transmitted and relayed to individuals, particularly misinformation, fake news, and certainly certainly that kind of factors into the much more, I guess, centrist and control approach that President Xi has, and certainly some of the data security and data protection laws that have been introduced very recently as part of the kind of upheaval of tech regulations look to address some of those issues. Creation of an oligarch class in China is a risk to stability. Conspicuous consumption is increasingly frowned upon. Jack Ma, very publicly had his wings clipped around the time for essentially making some disparaging comments about the government prior to the financial IPO, and it's only really recently that he's been able to get back into more kind of public life and kind of get out and about again. So that's been very much following in a way the Putin playbook in Russia, but perhaps slightly less aggressively. And then geopolitics, another real risk to stability. China's relations with the rest of the world. The trade tariffs have been hugely costly. I think I saw a number of $140 billion of additional tariffs being paid since they were introduced in 2018. So China's relationship with the world is increasingly important, and perhaps we're seeing a bit of a thawing there under President Biden, particularly as we head towards midterms. So there's a lot out there. So perhaps if we could switch on to the next slide, please. So how to kind of increase stability and reduce the risk? Well, one angle of common prosperity is localization, and essentially less reliance on foreign imports and import substitution. Excuse me. And that's a pretty good theme with investing at the moment. So tech and energy are two that really stand out. Energy security is increasingly important in China. Big importers of oil and coal. So essentially they're developing much more in terms of gas-fired electric plants, gas heating, moving to renewables, away from those kind of energy sources where they're big importers, where there's kind of risk in terms of supply chains. Semiconductors as well, it's a hugely strategically important part of the Chinese economy, and certainly the US-China tensions of the last couple of years have really kind of thrown this into sharp relief in terms of the reduction that China's experienced in terms of access to leading edge chips. So what you're seeing now is the Chinese government really pushed the local chip companies to invest heavily to try and catch up. So SMIC, large chip manufacturer in China, now investing $5 billion per year, which is a pretty big step up from $2.5 billion in 2021. But this is going to be an incredibly hard, difficult technology upgrade to execute, because you talk about them or SMIC investing $5 billion. Well, 100 odd miles across the Taiwan Strait is Taiwan Semiconductor investing $100 billion in capex in the next 3 years. And that really links into a lot of the geopolitical issues. The fact that China is a few years or several years behind in terms of semiconductor technology, doesn't have access to the latest technology, and then just across the sea is TSMC, which are constructing probably the most advanced semiconductor manufacturing center on the planet, investing such a huge amount of capex that that kind of flywheel effect should benefit them hugely, and how China approaches that is clearly a very big geopolitical issue, which is likely to play out in the next few years. In terms of other localization themes, well, there's a few out there. Sportswear within China is quite an interesting one. China's consumers are turning away from international brands and becoming more fond of homegrown brands. Software companies in China are really benefiting from the push to try and replace SAP and Oracle in terms of big databases. And then also specialty chemical companies as well. China still imports a lot of specialty chemicals, but manufacturing capacity is being built to supply that locally. So there's a lot potentially there. Perhaps we can have the next slide, please. So back to the point a little bit about energy here. China's green commitment isn't sadly just about saving the environment. It's also very much about energy security, as I mentioned. Hydro, solar, wind, nuclear, all energy sources in abundance in China versus imports of coal and gas. But also, it's important just to highlight the amount of countries now that have or are planning carbon neutrality targets. And China is very much dominant in renewables, particularly in solar and wind. So that's going to be a huge potential source of demand going forward, and should really benefit a lot of those companies. But the transition certainly isn't straightforward, and this is another issue in terms of pressures on China's economic growth, in that we are seeing a certain amount of rationing of power. Essentially China has been running short of some supplies of fossil fuels. A lot of regions have pretty aggressive emissions targets that they need to reach, and as such, the coal-fired capacity has had to be shut down. So we've seen quite a big impact in some regions, particularly in heavy manufacturing industries, which have shut down. There's even been mandates to kind of turn air conditioners off, or at least turn them up in terms of the temperature that office buildings are allowed to be kept at, in order to conserve power. Another good example of disruption from the energy transition is shipping. I mean, I'm sure people are very familiar with all the supply chain issues that are going on at the moment, and certainly there's a lot of factors behind that. But one of them is the shipping industry, and and the emissions regulations there that have been introduced, which have essentially meant that ships have had to, or at least before they've been able to upgrade their propulsion systems, they've essentially been running slower. So slower ships, reduced capacity, less ability to move things around. So there's a lot of potential disruption out there. So if we could move on to the next slide, please. So that really just want to just highlight China's market share in various renewables. So you can see, for batteries and solar, China are extremely dominant in terms of the market share they have of those renewables. What's also quite interesting is if you look within those markets within China, those market shares are really captured by a fairly small handful of companies within those industries, and so they're really able to have pretty attractive pricing because of the consolidated nature of the industry and pretty decent margins. And a lot of these companies are A-share companies, so the companies which are owned by locals to a large extent, or at least locals can own these stocks. So they're not the kind of US listed companies which potentially face some existential threats in terms of the US-China relations. So that's quite an interesting part of the market to invest in. So next slide, please. So and so also just want to highlight what's really been one of the key drivers behind this the introduction of common prosperity, and that's very much President Xi, who is now one of the most powerful Chinese leaders that there's ever been. And he's very much a populist in terms of trying to reduce inequality. Really doesn't tolerate much or any dissent of the Communist Party, and also very much a centralist in terms of trying to consolidate power very much with himself and the state. And this is quite a timely moment to be talking about his power, as we've just the government has just finished the 6th plenum of the 19th term of the Communist Party, and he's managed to pass a historic resolution, which is a pretty important document, which really sets out the fundamental beliefs and pathway of the party. And it's really been the only time, or only the third time in the 100-year history of the Communist Party that a leader has been able to get one of these documents through. So previous leaders were Mao Zedong in 1945 and Xiaoping in 1981. So he's very much consolidated his power. It really underscores the abandonment of the 2-term limit. So he's likely to be in power from 22 until 27, and then possibly onto 2035, at which point he'll be the same age as Joe Biden today. So similar in a way to Putin and MBS and Erdogan in terms of that power consolidation. And I think that's quite an interesting point about emerging markets, in that a negative point in a way, in that emerging markets a lot of that's been around kind of less reliance on politics and strengthening institutions, as countries kind of move more towards democracy, and you're seeing the largest country in emerging markets now move away from that to some extent. So that's something to be monitored, and he's certainly, as I mentioned, taken a leaf out of some of the other autocrat playbooks in terms of how being quite careful to neuter some of the tycoons. So there's an awful lot of key person risk within China, within President Xi. So that is something to monitor carefully. But if the past is a guide, then it's been relatively friendly towards business within those limits that have been tested. So perhaps we could move on to the next slide, please. So so really just kind of summing up, really. So clearly there's been some pretty big regulatory changes against the backdrop of what's a pretty tough economic conditions within China at the moment. See, the education regulatory change was a surprise. But I think to some extent the changes within the tech sector really should be considered in the context of regulatory change. It was overdue to some extent. There hasn't been, or the kind of anti-monopoly legislation hadn't been updated for well over a decade, and the technology landscape has been changing very fast. We think we've highlighted that the importance of the private sector and how that is going to be really critical in terms of elevating China's wealth so that it becomes a moderately prosperous nation by 2035. And capital markets are going to be very important, although it's fair to say that the capital markets, or domestic Chinese capital markets, are likely to see their importance increase relative to those in the US. So highlighted the key person risk with President Xi, although, like I say, we think he's going to be relatively friendly towards business. And then, I suppose the real highlight is a lot of this regulatory change is not all of it is negative. It's pretty straightforward if we think identifying which companies and sectors are likely to be on the wrong side of common prosperity, and where there's more likely to be more higher risks in terms of sectors. So that's it. So thanks for listening so far. Perhaps I'll stop there and take any questions if there are any.
Thank you, Nick. I appreciate the discussion. Very timely as well. And I apologize that we did have some technical issues on my end on the last part of your intro. So thank you for carrying forward. And I will get into some questions here. So one question that I certainly have, and I think you're touching on it in a number of different ways there. But I'm based in Canada. I'm an investor. I'm going to put my money into China because the growth story, it's stabilized. All the different things that you're talking about, the potential there is still huge. But what gives me confidence as a foreign investor that even if it's capitalism in China that continues in a I guess with Chinese characteristics, if you will, what protection do I have as a foreign shareholder that this isn't going to continue to go down, the state-owned enterprises, that we're actually going to see sort of the returns accrue on that basis? And you mentioned anti-competitive legislation. That's not different than some of the things that we do in developed markets, but it's certainly a bit more heavy-handed. And there's a lot more control in that regard. So I guess maybe just some context around that.
Yeah, I mean, I think that's a really interesting question. And I think, as I mentioned, it's always been a bit risky investing in China, in the US, and domestically, but the US has had a different set of risks, if you like, in that, you've had these variable interest entity structures that are used in the US to get around laws on foreign ownership of key assets. And that's always been, something that's been a bit of a challenge to kind of get your head around a little bit in that, it's maybe the governance assessment challenge within China, different in that, it comes that it's a bit, and it's different, but it's the same in a way. And it's similar to the rest of the emerging markets in that you have to really trust the person or individual that controls the business, not to essentially rip you off if you're invested via an ADR, because it's possible because of how these VIEs are structured. So that's always been one risk, and then I think the second risk is really about how the US-China relationship evolves and what that means for ADRs. I think the moves in the education sector were really interesting, given how that education sector is dominated by ADR listings. So the Chinese could be very aggressive in terms of regulations, knowing that most of the shareholders were foreign, and there wouldn't be too much blowback domestically. So I think that's a kind of, in a way, the VIE risk, and it's been around for a long time. That's a bit of a new risk. And then you've got these risks in terms of how the US reacts to that. So I don't think there was any particular reaction to the education sector, but certainly we've seen more US regulations over what local US investors can own in China. And so that's more of a capital flow risk or anything. But I think when you put all that together, it means investing in US or Chinese companies in the US has become more risky. That's why companies are relocating or relisting themselves or getting secondary listings in Hong Kong, which reduces the risk. And then the safest place in terms of investing in China is actually probably the A-share market now from a regulatory perspective, in that at least if you're investing alongside Chinese individuals, there's some degree of protection there, I would say.
Good. We did get a question in the chat. Just one moment, please. So what industries or stocks in China do you see the most attractive now with respect to growth and valuation? I know you touched on a number of different themes there, the common prosperity, the green, sort of more the green transition. So yeah, just maybe to summarize those thoughts from you.
Yeah, I mean, I think when looking at kind of Chinese investments now, I mean, you have to, unless you're willing to take some pretty big regulatory risks, you have to really think carefully about which kind of companies are on the right side of common prosperity. And so a lot of that, I think, is coming into companies which don't do anything too controversial. So there's gambling. Gambling is probably a bit risky. Some of the pharma companies in terms of drug pricing, some of the larger internet companies, there's still a bit of regulatory risk out there in terms of how some of the laws are being created. So that there's probably opportunity there, but those are a bit risky. In terms of where there's less risk, and some of the sectors we like, which really benefit from common prosperity and those kind of tailwinds of localization. So software companies, there's some good ones out there which are, as I say, being benefited from this pressure to try and kind of replace kind of more developed market software companies. As I mentioned, there's some consumer companies, some staples companies, clothing manufacturers, the a fairly obvious source of potential investment. And then the renewables companies as well. Really, there are a lot of good companies which have A-share listings, which are really strong at what they do. So the solar ones, the battery ones, some real world leaders there, which are really kind of also getting into quite a nice position in terms of market strength, market dominance, being able to start kind of getting that flywheel effect going in terms of the amount that they can start investing in developing products. So those would be the areas I'd highlight. So we've got several investments in our portfolios in those types of companies.
Okay. And I know you're part of the emerging market equities team. So broader, we're thinking more broadly. There's a number of countries that have benefited from the rise of China. What is the ongoing shift right now? What are the ongoing implications for some of the other emerging markets that have strong ties to China as China looks to move up the value chain? Does it change? Is there opportunity there, maybe just outside of China, or how is that relationship changing?
Yeah, I mean, I guess as China moves up the value chain, there's a lot of, in terms of the amount that's been invested or being invested in those efforts. There's the supply chain that's within semiconductors, semiconductor equipment companies, which I think are quite interesting at the moment. The semiconductor companies themselves are probably a bit risky in China, given they're being forced into kind of doing all this capex, whereas the equipment manufacturers probably in a nicer spot there. Outside of China, I mean, the obvious places are benefit kind of from, I suppose, reducing the kind of supply chain risk as global supply chains try to become a bit more diffuse and less kind of centralized in lower cost places. So Vietnam's been benefiting hugely from that, seeing a lot of kind of reshoring in that country, and then also Mexico as well, a bit closer to home, really benefiting from the kind of China tensions and also from a relative cost advantage that's basically completely eroded now in terms of manufacturing. And Mexico is a pretty cheap place to get stuff made for the US market today.
Maybe just one last question, because if we're thinking longer term, you talked about the importance of strong capital markets within China, and we talked a little bit about the foreign capital, and so I guess where do you see capital markets evolving? I know coming out of 2015-16, there was an emphasis on stabilizing that and maybe opening up a bit more. Seems like we're going in a different direction at this point in time, but is there going to be a turn here after this most recent sort of regulatory clampdown to maybe open things up more, or is that really just dependent on how things shake out from the US-China, I guess, ongoing tension?
Yeah, I think in terms of, the big trend is going to be companies moving from the US or Chinese companies moving from the US with their primary listing, so moving to Hong Kong. Yeah, that is likely to continue to occur. The Hong Kong Stock Exchange is a publicly listed company. It's doing quite well out of that. And then also continuing to strengthen the domestic stock exchanges. And that's something we do see progress there. I think when we first started investing in A shares, which was probably, it was a long time. We invested in A shares via before kind of the Hong Kong Stock Connect, when it was kind of all you had to get the Q fee kind of capital permission to do that. But the A share market has evolved a lot, and we continue to expect that to occur, in that things are, governance standards are improving. You can speak to investor relations people who companies now hire. A few speak English, and the quality of reporting is getting better. So the market has gone from something that felt very risky 7 or 8 years ago in terms of the integrity of the market and the ability to invest, even after Hong Kong Stock Connect was introduced. Whereas now, liquidity is pretty good, reporting is good, access to companies is good. And they're just beginning to start kind of taking on board investor concerns and the like. So they're well behind a lot of other emerging markets in terms of your ability to interact with companies and kind of persuade them to do things differently. But it is occurring.
Well, that's great, Nick. And, I guess one thing I really appreciate about today is that we are getting a bit more of a global perspective. Here the media is obviously, there's a bit more of a U.S. bias in North America, certainly. And so a lot of what you're going to hear would argue sort of against, investing in China, and that, that opportunity is now lost. So it's interesting to get a bit of a different perspective. It doesn't sound like it's not without risk, but at the same time, there is opportunity there. So appreciate your time today. Thank you so much for joining us, and look forward to connecting with you again.
Great. Well, thanks, Ian, and thanks everyone for listening in. Much appreciated for the invitation to speak.
Okay, there you go, Nick Robinson from Aberdeen. So again, once we'll get this up and posted if there's anything you want to look at once again. But thank you very much, and everyone have a great day.